Hey everyone, so this is just a quick video on a small lesson about options. They're highly advanced financial derivatives, so explaining them is going to take a while. So I'm just going to start off with this video, and I'm going to use an example of a couple that wants to buy a house. So Mike and Molly want to buy. Mike and her husband Molly both want to buy a house. The house they love cost $100,000, but they can't afford to buy it until December 31st, 2018. So basically, the housing prices have been moving up steadily. I mean, this isn't true, but it could be. In this case, it is. In this hypothetical situation, the housing market is moving up steadily. So Mike and Molly basically want to lock in their price of $100K because they want this house and they know they can afford it. And they don't want the house going to 110, 115, 120,000 because houses in this price range are increasing in value because everyone wants affordable housing like that. And there's not many left in this situation. So basically, for $1,000, they can lock in their price at $100,000 until December 31st, 2018. So basically, they're paying a $1,000 premium to have the house's price set at $100,000. So if the price ever goes over $100,000, they have the right to buy it for $100,000, no matter what. So if the price goes above $101,000 plus the $1,000 they paid for a premium, then they're in the money, and they can either take the house and sell it to somebody else at a higher value. Like, let's say the price goes to $110,000 for the house. They can take the house and sell it to somebody for $100,000 and only lose the $1,000 premium they paid. So they pay $1,000 and they just made $9,000 because the price of the house increased by 10%. So they made 9 times their money profit. So basically, that's the best case scenario. Is the price goes up above the strike price, 100,000. That's what it would be called, plus the premium, which would be 1,000. So if it goes above that, you're in the money. You're making money. But if it's under 101,000, you didn't make any money. If it's $100,800, then you lose $200 because you paid $101,000 basically in total. So once it goes down to like $98,000 for the house, you basically can just buy that house for $98,000, and that extra $1,000 you just paid on that house. So now you're paying $99,000 for an $98,000 house. Or you can just say, I don't even want the house anymore. And that's basically what options are. That's a 4-minute story, but that's just a small explanation of what options are like. And they basically work the same exact way. If you go to this NASDAQ option that's expiring December 31st of 2018, you can buy the right to shares at $190 for $5.34 a share. So basically, the strike, like the $100,000 for the house, is $190, and then the premium is $534. So since you're getting 100 shares, you're getting. Wait a second. You're getting $19,000 in QQQ stock. So you're getting the right to own $19,000 in QQQ stock, plus the 534 premium. So you're going to be paying a total of $19,534. That's how much you have to pay, basically, to have 100 shares of the QQQ, which is the NASDAQ, until December 31st. So if the QQQ price goes over 195.34, which is 190 plus 5. So the ask is 534 and the strike is 190. So basically, right now, all you're paying is for time value, which is just like, since it's not 190, it's only 186. You're not getting any intrinsic value. If you bought calls that were less than the current price, like over here at 180 or 183, you'd be getting some intrinsic value, you know, because you're getting the right to buy 183 dollar a share NASDAQ stocks instead of 186.74. So you're already up over $3 a share right from the get-go. Whereas here, you need it to move up in order to become profitable. So there's a lot more to them, and there's a lot that I didn't cover, but this is already a 7-minute video, and that's just touching the surface with these. Leave some comments and let me know what you think.